This is the market update as of August 2022 with market data as of August 31st, 2022. Inflation turns out to be the story for 2022. It's the same level of high inflation throughout the last 2 years, points to inflation no longer being transitory. Inflation is not good for financial assets, being stocks or corporate bonds, and they do worse during the periods of high unexpected inflation. Expected inflation is fine because it's already priced into the market. It's the unexpected inflation that make asset classes perform not well. And unexpected inflation is calculated as a difference between actual inflation and what we expect the inflation to be. The expected inflation in these calculations is represented by the net difference between the 10-year yield and the TIPS rate. And as we look at these graphs, the corporate bonds on a real and nominal basis and the equities, in this case represented by SPX, on a nominal and real basis, have performed worse during periods of high unexpected inflation, and the data has been sliced and diced based on quintiles of unexpected inflation. Small caps historically have performed better when inflation is higher than expected, and this is represented by the data. As we have looked at the small cap stocks, the return of the small cap less the large cap stocks over the last 40 to 50 years, and we have plotted the data as we see in the graph across different quintiles of unexpected inflation, and during periods of high unexpected inflation, small cap premium has returned, and value stocks, which is presented by the net differential between the return of low price to book stocks and high price to book stocks, are tending to do better during periods of high unexpected inflation. And last but not least, gold is the best hedge against inflation, the unexpected inflation in this case, and we can see that in the graph, again during the periods of high unexpected inflation, the fifth quintile of unexpected inflation, gold on a nominal and real basis have performed the best. Sustained inflation has become a risk factor in equity valuations this year, and it is magnified by leverage, long-term fixed commitments, and higher risk of a failure in 2022. Generally, companies with high stable cash flows, low debt, higher pricing power, and higher gross margins and short duration investments are the companies that have a reduced exposure to inflation risk this year. So rate hikes. Rate hikes have been the story of 2022, follow on the inflation, and central banks have continuously raised rates in 2022, and the 10-2 spread, which is the net difference between the 10-year Treasury yields and 2-year Treasury yields, have remained inverted for much of July, August, and into September as displayed on this graph. And generally, the inverted yield curve have been an indication of a recessionary environment. But given the fact that the markets have already priced in the expectation of rate hikes, there's lesser chance of a recession and more chance or possibility of soft landing. On the other hand, aside from the realized rate hikes, the Feds have generally agreed to trim $30 billion of Treasury holdings and $7.5 billion of mortgage-backed securities per month from the balance sheet, which is equivalent to a decline of about $142 billion from June to August. And they're also going to trim $60 billion from U.S. central bank Treasury holdings and $35 billion from mortgage-backed securities starting September. Many economists believe that these tightenings of the balance sheet by itself is equivalent to at least 50 bips or 0.5% of rate hikes. And as we're seeing, the U.S. banks, the Feds, the Bank of Canada have already raised rates by 300 bips, and the U.S. Feds are expected to raise rates by 75 bips in September on September 21st. On the other hand, the ECB or the European central banks cannot raise rates as aggressively as the North American market, given the strength of the North American market. As a result, Euro is struggling with respect to the US dollar. Now let's look at all of these rate hikes and this impact on markets. As we're seeing on the graphs on the right, there's an inverse relationship or inverse correlation between the level of long-term rates, 10-year yields in this case, 10-year Treasury rates in this case, and the PE ratios of the entire market. We're looking at the S&P 500. And the measure that we're using is the cyclically adjusted PE ratio, or CAPE. As interest rates rise through the Fed's rate hiking period, the PE ratio of the market continues to drop as shown on the picture on the bottom right. If we look at the earnings yield, which is the reverse of the CAPE ratio, we can see that there's a strong positive correlation on the top graph. And the positive relationship between the level of interest rate and the EP is clear in this image. So as the interest rates are going to rise, the PE ratio of the market is going to drop throughout 2022. When the EP ratio or the earning yield is close to the 10-year treasury rates, it's generally an indication that there's uncertainty in the market. Let's look at a currencies market. So the strength of the US dollar relative to all developed market currencies and the majority of emerging market currencies is evident from the numbers displayed on the tables, and the rising yields in the North American market and specifically the US markets by the Fed has strengthened the US dollar, except against those currencies that are backed by commodities, in this case Brazilian real and pesos and maybe CAD. Given the strength in the oil markets and also gold prices. Surprisingly, ruble has been the best performing currency year to date as a result of severe Russian capital control efforts. Ruble surpassed real as the best performing currency year to date, rising 21.6% against the US dollar and by 1.3% in August alone. This is mainly due to the Russia's capital control efforts, lowering Russia's interest rate from 14% to 11%, forcing exporters to sell foreign currency and demanding natural gas to be paid for in ruble, as well as the strength in the oil markets and oil prices. Many traders, however, have not found this price to be stable and liquid, as prices on the monitors in the physical markets tend to be different. As we mentioned before, the European Central Bank cannot raise rates as aggressively as the Feds or the Bank of Canada, and euro has fallen below parity with respect to the US dollar. Indices and select exchange-traded funds. As we know, capital markets have experienced a slower growth and upbeat in 2022 because of rising inflation, rising rates, Fed's hawkish policies, supply chain disruptions, geopolitical risk, volatility in the commodity markets, and overall this year, high yield, low size, and value stocks are tending to do better in a rising and tend to do better during the early stages of economic cycle recovery. And if you look at the indices, we can see that all of these factors, such as the rising rates of inflation and supply chain disruptions and heightened geopolitical risk, have had its impact on the equity markets, and year-to-date returns have been negative for most of the indices. And oil futures, WTI futures, and gas futures, and of course palladium have been doing really well this year. Russia-Ukraine crisis continued to weigh on the rising inflation and tight inventories, and markets are experiencing a stagflationary environment. And among exchange-traded funds, as we see, the bargain basements of 2020 tend to do better this year, which includes oil, infrastructure exchange-traded funds, gold, merger arbitrage, and the ones that are doing worst includes Bitcoin and technology. Bitcoin tends to act like very risky equity, and the risk is magnified during high inflationary environments. Taking a long-term value perspective this year, we're going to remain focused on financial sector, oil and gas sector, COVID recovery themes, and collateralized investments that are resilient during inflationary environment. We're going to stay focused on the high-quality segments of the market. Looking at the sector performance year-to-date and on a month-over-month basis, we can see that year-to-date, it's the same theme: oil and gas, power, marine, infrastructure and asset-intensive assets, and capital-intensive sectors have been doing best. And the sectors that have not been doing really well includes computer, peripherals, electronic retail, biotechnology, healthcare, automobile manufacturers. From an IPO perspective, the transaction activity has significantly declined in 2022, and we have peaked in the highs of 2021, both on a proceed basis and on an account of a transaction basis. IPOs have declined, and this is expected as a result of the rise in interest rates the rise in equity risk premiums, and it's becoming more expensive to raise equity in the markets, which causes the markets to slow down. From a sector perspective, financials and healthcare have been the most active sectors from an IPO standpoint. To learn more about this market update and all the details of the analysis, and to learn more about the companies associated with this analysis, hover over to our website at www.modelyzeinvestments.com and visit the Basic Modelyze tab to download these reports. Thank you.